Welcome to Inside Networks INBrief, coming from the Income and Defensive Asset Symposium. Our guest today is Gabriel Carey from Cadre Capital Partners. Welcome.
Thanks very much, Jamie. Absolute pleasure being here. Thanks for putting on the session.
Yeah, tell us a bit about yourself and your practice.
So I now run a wealth management practice focusing on the high net worth clients, typically $5 million or more. And at that stage, really we're looking at risk reward, so capital preservation and then return second.
So Income and Defensive Asset Symposium kind of fits straight down.
Absolutely.
Really volatile times at the moment. What's your approach been in that defensive element of portfolios?
So for us, it's very much around the capital preservation side.
Yes.
We are looking for income, but income's secondary to capital. So we've got a clear path to ensure that over 5 years you're not losing capital, hence defensives.
Yeah, pretty easy to get caught up in the market rally or bond rally in the last quarter. How have you, or 6 months? How have you gone there? Have you seen any short-term pain? Or?
No, pleasingly in the defensive space, we didn't have any duration.
Yep.
And in fact, now, even though now may be the time to put duration risk back in the portfolio, we're not, because we're very focused on capital preservation. Yeah. So over the last 6 months, it's been happy days for us.
Yeah, it's an interesting one, isn't it? As my day job is a financial planner, and we've just started to put our toe back in, a third into duration, but a really uncertain time with inflation and interest rates. So could get caught, but let's see what happens. So what other things within that defensive component do you hold?
So we put hybrids in there, despite the
so these being bank, private?
Absolutely, only bank. So we'll only do the major fours, because we see there if there's going to be an issue, there'll be a much wider ramifications than a coupon payment from a Commonwealth bank. Yeah,
what do you think about, I saw term deposits at Macquarie Bank for 2 years are up at 3.5%, and someone before that I was interviewing said Bank of Queensland's got a 1 year rate at 4%. Pretty amazing rates, where we 12 months ago we were talking about 1/4 or 0.5%.
It's been a long time coming, because we've come. I remember back when it was 8s, 10s, and that was the normal.
Sure.
Now, if you're getting a 4+, well, you start to really look at that additional risk you receive or return you're receiving when taking some risk. So it's very important.
And tell us a bit about how you found the symposium so far. We're halfway through. We're advisors ourselves, and we've built something we think is a great format to exchange ideas. So what's your feedback been?
So honest feedback, I always sort of wear my heart on my sleeve, and you're not paying me to be here.
We'll cut it out if it's the wrong way.
In all honesty, look, the presenters here, or in fact the whole forum, the feeling of the forum, it's just, I mentioned it to a colleague, it's just a level above a PD day. Any other presentation you'll go to, there's always some underlying interest from either fund managers, from someone pushing a product. I think you've got a genuine interest in furthering education amongst advisors, and you're curating the people that are coming to ensure you're getting that quality of content as well as presenters. So it's been excellent.
Well, we really appreciate you being a part of our network, and thanks for your time today.
Pleasure. Thank you.